All we're going to talk about is the special needs planning aspects of your lives, how to access and maintain benefits where appropriate, how to utilize other available planning tools that are out there that you might not know about, and how to maximize whatever resources you have to the fullest extent possible. So that's going to be the focus of today's discussion. If that sounds like it's a meaningful use of your next hour and 10 minutes, you're in the right place, because I do appreciate the investment of time you're making in being here. I want to make sure you get something out of it. I want to make sure you get your topics addressed, the questions you have. That's the most important use of our time together, is that you leave here feeling more confident, more assured in your loved one's future, having attended this session. So that's really all I want to get out of this, is you feeling more comfortable and more knowledgeable. That was us on my 6th birthday, which you'll notice when the picture comes up, and there it is. That's my 6th birthday. Which one's me? Yeah, the one in the back. In a special needs family, the loved one with the challenge is always front and center. In addition, what did I get for my birthday? A stuffed Snoopy doll. It's my birthday. Guess who else got one? Yeah, my younger brother. So I understand what it's like to be in the special needs world. And you can see we're raised really well. The highlight of the room was actually the linoleum floor that they put in the early 70s. Parents are very proud of that. Great in a kitchen, right? Having a plastic floor in a kitchen where hot fluids hit it. Great idea. And my brother's, of course, sitting in a case of Salem cigarettes. So just perfect parenting. My parents are the best clients I've ever had. But I'll actually share with you that that can be a challenge as well, that well-meaning parents will sit through the session, will know the things they're supposed to do for their loved one, and still not get things done. I can tell you that my parents were in my office in Chicago 2 months ago. It was the first time we finally changed the beneficiaries on my parents' IRA plans to be 100% to my brother, actually to a special needs trust, which we'll talk about. It had been 50-50. And my parents said, well, we want to be fair and equal. I'm like, I got a college education. I actually was educated here in Nashville at Vanderbilt University. I feel really grateful for that. I was able to launch a career with the knowledge I gained from that schooling. I don't need those resources. My brother does. And so that's something that all the parents in the room have to deal with, is what's fair. And as a financial advisor, I know there is no correct answer. It's probably not equal amongst all your children, but finding the right balance is something you'll probably struggle with the rest of your life, and I have sympathy for that. But clearly it's not going to be necessarily dollar for dollar the same amounts. So allocating that correctly is important. It made my mother cry when I forced her to sign the IRA beneficiary designation, giving it all to my brother. But I explained to her how happy I was with my life, how I didn't need the money, and how he might well need it in the future. So part of the planning we do is making sure that the right resources are allocated the right way. And we'll even talk about what the right kinds of resources are. If you've got a house and retirement accounts and insurance, who gets what, right? Because that seems like it's obvious. You'll split it up the same way. Well, no, because there's different tax reasons behind making those decisions. We'll talk a little about that today as well. So Rachel, are you close to being ready?
You go on that side. And
I go over here. I'll go where
you
you
can
tell me to
look
go.
at your monitor and see the polling
Rachel's
results.
the goddess of all, so I'll do whatever Rachel tells me. Good planning. All right, so that is us. That's me. I already mentioned what I do, why I'm here, and how grateful I am to get to present to you all. It really is an honor for me to come down and do this. The mission of our firm is really to educate as many in the special needs community as we possibly can. A handful become our clients, that's great, but really the goal is to find audiences like this of families who want to learn more and give them the tools they need to have the best possible life for their families. Okay, so throughout this presentation, I'm going to struggle with this, but person-first language is really important to me. And the autism community, they've kind of flipped this. They don't want to be called autistic individuals as opposed to an individual with autism. So the language dynamic in our community is constantly changing. I just want you to understand that I'm sensitive to that. I'll try to use person-first language in a public speaking engagement like this is, but I may slip. It doesn't mean I'm not caring. Okay? Hopefully you all accept that. So these are the 8 topics. If you feel you've got all these completely covered for your family, that's the door. Go enjoy some snacks. And congratulations. My own family doesn't have all 8 of these knocked out yet. So I can tell you it's an ongoing path to success, and it's truly a journey. Don't feel like you have to have it all solved next week when you leave here. It will take time, and it takes a lot of reflection as to what you want. But these are the 8 topics we're going to cover. We're going to start with public benefits. That's the core of all the planning, understanding what's available and how to access it and how to keep it. We're going to move on to ABLE accounts. Relatively new. In fact, ABLE accounts were just available the last time I presented to this group. Special needs trusts, really the cornerstone of financial planning in families with loved ones with special needs. Then beneficiary designations. I mentioned how my parents had waited 50 plus years to change those to what I really wanted them to be. Well, that got fixed for them. It's something you all need to think about where you have those, where they need to be reviewed. Then we'll get to decision makers. There's a number of different ways you can help loved ones in your family make decisions that are legally binding. Understanding the differences between those and which ones are most appropriate will be one of the things you'll walk away from here knowing better than you did before. We'll move on to vocational issues. The biggest takeaway there is going to be the fact that the dollars you make working is probably not the most important reason to have a job. Then we'll talk about housing. My brother still lives at home with my parents. He's 51. They're in their 80s. That's not optimal. So we'll talk about what housing opportunities are available, how things are changing in the communities, and what the future might look like for housing. And then we'll get to care guides. Care guides are also known as letters of intent. Letters of intent are typically drafted or provided by attorneys. We think care guides should be more flexible, more personable. And so we'll talk about what we think an ideal care guide looks like so that if you're not around to share what's in your head with future caregivers, if your loved one's not able to communicate all those needs, him or herself, you'll have a document that someone could pick up and understand exactly what that person wants and needs. Okay, so those are the topics we're going to cover. The key in the middle is communication. As I mentioned, I've had an ongoing dialogue with my parents for now 50 plus years. My brother still lives at home, and we just changed the beneficiaries 2 months ago. Communication needs to happen throughout your entire family. You never know when there's another loved one outside of your immediate household who wants to do something to help. If they understand what your planning is, what the goals are for everyone, they can make great contributions. Not knowing those facts, not understanding the planning you're doing, can cause significant problems to good planning you might otherwise have had in place. Okay? So with that, we'll start with public benefits. In front of you, you should have a handout. Hopefully anybody who came in late still has one. On the top half, you'll see there's a blue section. Those are available to people who have worked. The bottom half are what are called means-tested benefits. Those are going to be benefits that you have to qualify for by being poor. Poor in the government's mind means you have nothing more than a house, a car, and $2,000 of other financial assets. There's some other incrementally small things, such as items used for a trade or business. So if you have your own business, you can have those assets, and those don't count against the $2,000 limit. But it's a very finite number of things you can have. And why that's important is that the means-tested benefits, the bottom half of that chart, are incredibly valuable. So in Illinois, you lose your school supports at age 22. Anybody here from Illinois? There we go, one other family, well, lovely. Anybody here from Montana? I'm convinced no one lives in Montana. I'll show you why that's important a little bit later, but I've never been in a presentation where anybody's been from Montana. I'm pretty sure people live there because people travel there, unless y'all jump in from Idaho and the Dakotas to meet them when they land with the plane. I don't know what's going on in Montana, but we'll talk about Montana and why that's important later. But the key to public benefits is knowing what's available, how to access it, and how not to make mistakes when asking for the benefits, which is where, sadly, 2/3 of all people get denied, even though they're entitled to the benefits. Okay? So just by show of hands in the room, how many of you have loved ones in your family who are still in the school system, under age 21, 22? Wow. Okay, almost everybody who's here present. I don't know people online, if that fits your circumstance as well, but we'll definitely talk about that in more detail since all of you have that as a relevant aspect to your planning. So we want to make sure that the transition away from school, as I bang into the microphone, the transition from school goes smoothly. In some states, it's a handoff. Literally, there's not much planning done. In other places, there's a great transition program, a one-on-one transition coordinator that makes that more of a seamless adjustment to when the bus stops coming. We want to make sure we plan for that as soon as we can. And again, qualification, as I mentioned, the individual can only have a house, a car, and up to $2,000 of assets in their own name when they go to apply for benefits and after they start receiving those means-tested benefits. And the two means-tested benefits are known as Supplemental Security Income, or SSI. This is where the government makes it really hard for all of us. The acronyms are so close. So SSI is the income benefit, and Medicaid is the means-tested healthcare benefit. Okay? Those are what we consider to kind of be the baseline benefits, what we want all of our loved ones post-age 18 to receive. Okay? One of the things that's interesting about that is the government has something called a list of compassionate allowances. Has anyone ever heard of that? couple people for compassionate allowances. Literally, when you walk into the Social Security office and you say, my loved one would like to receive benefits. He or she is now over age 18. He or she has no other assets, and she's not worked. We'd like to start receiving Medicaid and SSI. One of the things they'll ask you is, well, how does this person qualify? What's the disability that would allow them to get this benefit? And interestingly, in our community, in the CMD world, there are actually two that land on the list. Autism does not, Down syndrome does not, cerebral palsy does not. So those are not automatics. If you use the magic words, you will get them. You double check this, and Duchenne muscular dystrophy and congenital myotonic dystrophy, automatic qualifiers. So if your loved one has one of those two conditions, they will get benefits, assuming they're not working, making more than $13.50 a month. That number is significant. That's all the government looks at to decide if you're disabled and eligible for benefits. Makes no sense. You may have banker's boxes full of documents explaining all of your loved one's challenges. If that loved one can make art and sell it for $2,000 a month, they're not disabled. I don't care what they can and can't do. The government will look at them and say they're not disabled, no benefits. Period, end of discussion. So they look at the income ability. So that's a good reason to apply for these benefits when you're as close to 18 as possible. Because at 18, it's the magic age where the government says you're an adult. I'm 54. Most people would argue I'm still approaching adulthood, right? So the government said I reached it 36 years ago. So look at an adult at 18 and say, okay, you're 18, are you working? No. Do you have one of these disabilities? Yes. Okay, if you've got no income and no assets, and you have this disability, you're gonna qualify. We're gonna start paying you $841 a month. That's the SSI amount for 2022. With inflation, that should probably be closer to $950 next year. But $841 for 2022, in addition to Medicaid insurance as a baseline. If you have health insurance through an employer, and you're able to cover your child on that insurance, that still stays primary. But Medicaid's there as a backup. Okay?
So mine
Doesn't
is
require you to
different.
switch over.
The confidence monitor, can we put this?
But those are going to be the benefits you're eligible to receive right away. People say, well, you know, it's just $841. Does that really matter? Let's project out 50 years with no inflation. That's over $500,000 of cash available for your loved one's needs over their lifetime, and probably more than that with inflation. So to just scoff at $500,000, good for you, but for most of our clients, it's something we want to go attain. In addition, Medicaid, it's a backup. Obviously, you'd rather have other insurance in place other than Medicaid, but Medicaid will provide basic health care, and it's the only federal medical program currently they'll provide for long-term care support. So as your loved one ages, if they need long-term care supports, Medicare will not cover that. Private health insurance for that is incredibly expensive. So having Medicaid really is a nice comfort that if your loved one needs that, it'll be there for them. But it's important to maintain those eligibility benefits. So here's the chart that is our best effort at doing it in one page. All of you should have it in front of you. Those of you who are online, it should be downloadable from the conference website. If it's not today, it will be very shortly. So this tries to summarize those details. I will tell you the single biggest reason why people get denied benefits when they apply is because they don't know the questions they're going to be asked before they go in, and they get tricked. Does anyone know what the percentage of people who get denied benefits when they apply for SSI and Medicaid? I heard 90. Anybody else? 70? Okay. It's a high number. It's not quite as high as those. Those are god-awful numbers, but it's 2/3. Roughly 2/3 of all people who apply get denied, meaning that only 1/3 who are entitled to benefits actually get them on the first effort. Those who go through the 3 layers of appeal that can take years and lots of dollars with attorneys, eventually about half of them get it. So what we're looking at is maybe 2/3 of all potential beneficiaries for those government benefits eventually get them. And trust me, the process of going through the appeals is painful and expensive. So how do we avoid making the mistake when we apply for benefits initially? Well, one of the questions you're going to ask is, okay, so where does your loved one live? For most of you, you're going to say at home. Okay, the question they get you with is, how large is that person's household? Think about what I just said. How large is that person's household? What's the answer to that question? Good. Someone understands that a couple heads are nodding. Yes, the answer is 1. That person's household is 1. I don't care if there's 10 people living under your roof. Their household is 1, because once you're over the age of 18, you're the adult, you're the one applying for benefits. It's your earnings record they're looking at, not mom and dad's, which is why 18 is that magical age. Before 18, they're not going to get SSI and Medicaid if mom and dad have resources greater than $13.50 a month. Look at the household income. If your household is 1 and you're not working, your income is 0. So to make sure when we apply for benefits, we don't embellish our work abilities if we haven't worked. We don't tell them, hey, well, I think I can make $3 grand a month. Well, it's great you think that. Don't tell them that if you haven't actually done it. If there's no work record, don't give up your benefits until you actually go out and do it. In the interim, you say your household is 1, you're not earning money, and you have a compassionate allowance disability or something else which you then can show with medical records, your primary care physician believes will keep you from making a substantial gainful amount, which in the government's mind is $13.50 a month for this year. Okay, that'll go up again with inflation next year, probably closer to $1,500 a month. But that's how much you can make and still be poor in the government's eyes. So those are your key things to understand with applying and getting benefits. One of the things that trips people up a little further down the road is they get that SSI benefit. SSI will check based on their social security number about how many assets they have going forward. If they ever go above 2,000, they'll suspend benefits. We've also had multiple circumstances where our loved ones' families have had that person lose their benefits for no reason. The government from time to time will actually turn off the income spigot to make you reprove you're still eligible. It's a horrible thing to do. Families have done nothing wrong, but the government will do that just to make you reprove it. Or you decide you don't want it anymore and you just leave it alone and don't take the rest of the $500,000 you're entitled to. But many people don't know they have to go back and just simply resubmit documentation to get it. And that's a horrible fact. But people lose their benefits and don't know they can go back and get them if they're still entitled to them. Hopefully that won't happen to anybody in the room having heard this discussion today. How many of you in here have a loved one right now already receiving SSI and Medicaid? Anybody? 1, 2, 3. Oh, wow, okay, great. Congratulations. That's wonderful to have that as a baseline. So these are the ages. I mentioned Montana as a joke earlier. They're the only state that I believe is violating federal law. Federal law says you have to provide school benefits through age 21. On that map, a number with a plus after it means that you get the benefits through the school year in which you turn that age. So in almost every state, it's either 21 or 21 plus, meaning you finish out the school year in which you turn 21. In many states, it's 22 or 22 plus. The other outlier is next to us in Illinois, which is Michigan. Michigan goes out to 26. Anybody here from Michigan? Yeah, there's lots of reasons not to want to live in Michigan. But the reality is you can get an extra couple years of school supports in Michigan. So if you're in the tech sector in Illinois and you need a few more years of support before your child's ready to go on their own, Michigan's not a bad place to be to get that. But those are the two big outliers. Montana, where nobody actually lives, and Michigan, where you can get an extra 5 or 6 years of support. Okay, ABLE accounts. I think one of the questions we put into the system in advance is how many of you have an ABLE account for your loved one? One. Okay. So the majority of you can learn from this and understand how important ABLE accounts are going to be in your loved one's future. So an ABLE account has to be opened online. You can't go to your brokerage firm, your financial advisor, your bank and get one. You have to log on online to the state's plan you want to use. And one of the other handouts to be available online for you to download is our matrix that allows you to compare all the different state plans. There are currently 42 plans available. In many cases, your home state plan is absolutely fine and may, in fact, provide you with a state income tax deduction for contributions to the plan. So give that some consideration. We'll talk about the other ways to evaluate ABLE plans, but your home state plan likely is a best option. In a state like Wisconsin, they don't have their own plan, but they'll give you a state income tax deduction for contributing to any state's plan. So Wisconsin's in the process of creating their own. In fact, one of my colleagues who works in our Madison office is on the board to get theirs to come to life, but they'll be one of the last states to get one. Question. So we're going to go through all the details of ABLE accounts and figure out how early, all the details. But for an ABLE account, the only age requirement is actually a lower number, which means you have to have had your disability prior to age 26. Okay? So as long as the diagnosis is prior to age 26, you can apply for them at any age. But that's the one age limitation. So at birth, You get a diagnosis, you're like, wow, okay, this person might need some more help. They've clearly got a diagnosis. It's going to be qualifying as a special need. We can go ahead and get them an ABLE account. Question? Ready for a poll? All right. To show the poll. Show the poll. I'm excited. Let's see the poll. Do a drum roll? There we go. All right. So as we talked about public benefits, a lot of you have had some introduction to it. A few of you have already gotten benefits for your loved one. You're probably that 20% for yes. That's great. Probably those who actually answer the poll, a lot of you are actually getting benefits, which is great. The other thing I didn't touch on benefits, and we'll get to that now because those poll questions are up there, is the other Medicaid waiver services. One of the things that's interesting about government benefits is that you hear about them at the federal level. I talked about SSI and Medicaid. We talk about those in public settings like this because those are federal programs. Medicaid's delivered at the state level. That's important because every state has the ability to add additional supports and additional revenue to that 841. So in some states, you can get over $1,000 a month. In Illinois, we are completely bankrupt, so you get 841, you're happy to get it. There's no other major supports. In fact, Illinois has a waiting list of over 25,000 people who need additional services who are not getting them. It's dreadful. Some other states have big waiting lists too. Some states where you all might reside actually have it in much better shape where you're getting services by applying for them through your local care providers. And that's awesome. But the Medicaid waiver programs can provide respite, day care, support for vocational and recreational services, all kinds of additional supports you can get if you ask the right questions of your state support agencies. So that's an important part of those public benefits. Okay, ABLE accounts. Apparently the one person who had one did not hit the button. I know you tried, it's technology, I get it, I'm terrible at that. But the majority of you don't. We'll get into ABLE accounts in just a minute, and then we'll get to the special needs trust where apparently nobody has one. And we'll talk about why in this community it may not be necessarily essential, but you might want to consider it. We'll get to the rest of the questions a little later, if we can do that. So let's go back to the PowerPoint presentation on ABLE account slides. There we go, perfect. So the key elements to an ABLE account, why are they different from other accounts you have? They operate very similar to a Roth IRA or a College 529 savings plan. Those are the two most similar types of accounts you might be more familiar with. It grows tax-free. If the money comes out for that person's sole benefit, it's tax-free coming out. So it's a wonderful way to save for their future in a tax-advantaged way. It came about because some families in Virginia said, hey, my kid's not working. Other kids are working. They can save through a company 401k or 403b plan. They can save in their IRA if they have earned income. What about my kid over here who doesn't have that employment opportunity? Why can't they have a tax-free savings account? The government said, yeah, you're right. We should be able to do that. So in 2014, the law passed on the last day of the year. 2016, Ohio opened the very first one in June. And now we got 42 different state plans. And again, you do your evaluation, you figure out which plan you want to use, and you go to that state's website to open the account. And so the other great resource, in addition to the resource you can download from this conference, is actually the website ablenrc.org. So if you've got a pen and paper, ABLE-NRC, National Resource Center. That website has all the state plans. You can review them 3 at a time, side by side. Our matrix you can download has all 42. So if you want to overwhelm yourself, you can do that. We also laid out each of the elements we think are most important for evaluation. The ABLE-NRC site's a little more limited, but it's a great resource to view and see what the new things are with respect to ABLE. The newest thing that's coming down the pipe, which probably doesn't affect very many in this room, is there's legislation pending that would allow you to get into an ABLE account post age 26, looking at bumping that age from 26 to 46. So many of our people serving in the military who come back with significant disabilities can access a tax-free savings account if they're not working in the future, if that happens before they're age 46. So that's pending. I hope it gets passed this year. It'll be a great benefit for our special needs community as a whole. But some things to understand. Limited contributions. You can only put the annual federal gift amount in there, which this year is $16,000. So the most we can fund into an ABLE account at one time in one calendar year is $16,000. Okay? So that's a limit to consider. The other limit, if we're receiving those SSI and Medicaid benefits, is if the account value goes over $100,000, the next dollar becomes accountable resource towards that $2,000 limit. That makes sense out of my mouth? It made sense to me, but it might not to you. So again, the cap's $100,000 if you're receiving means-tested benefits. The $100,001st dollar starts counting towards your $2,000 limit. Okay? If you're not receiving means-tested benefits, let's say you've got other supports in place, you're not going to take the SSI and Medicaid, or you didn't qualify for it for whatever reason. Maybe you're making too much money, but you still clearly have a disability. You can still use an ABLE account. And your limit goes from that $100,000 amount you have to be worried about up to the state limit for the state's College 529 plan. Don't ask me how they come up with these rules, that's what it is. So that number is typically between $400,000 and $550,000. So it's a much higher limit if you're not receiving means-tested benefits. Okay? So those are your limits in terms of the maximums and minimums. But an important thing to understand is this last one. And this one catches some families and they really get upset about it. There's legislation pending to change this, but it's currently in place. If your loved one has an ABLE account and received Medicaid services, maybe for 10 years that are worth $60,000, and they're to die unexpectedly with an $80,000 balance in their ABLE account, the government gets repaid for those Medicaid services before anyone else in your family can benefit from the balance in there. So think about that. We may not want to have a huge ABLE account if we're worried about something happening to our loved one in the near future. So use it as a tax-free savings account, small investment account, and if things are looking good health-wise, let it grow and expand and use it for bigger things down the road. But keep in mind, if they're receiving Medicaid services, there's a risk of a payback to the government for those benefits that are received through Medicaid services. The government's not really good at balancing their budget. They're really good at keeping track of what the Medicaid services are worth. So they'll come to the estate and say, we want to get repaid, and by the way, when you signed up for it, you understood on line 72 when you signed off on it that it's in there. So that repayment's at risk. Illinois is one of the states that said they're not going to do that. We'll see. I feel good that public policy over the next 3 to 4 years will get rid of that. But right now you need to be aware of it if you're making these plans larger. Question in the back. I'll repeat it. Go ahead. It's okay. I'll repeat the question. Go ahead. And the microphone's not on. Great. Okay. So the questions are for an ABLE account. For a Roth IRA, you've got to have the money in the plan for 5 years before you can touch it. Otherwise, it's a taxable distribution on a Roth IRA. After that, when you take the money out of a Roth, it's a tax-free distribution regardless of your age. Okay. For an ABLE account, you can put the money in January and take it out tax-free in February, as long as it's for that person's sole benefit. Where families get in trouble, let's say they get a nice, generous gift from someone for 10 grand. They decide, oh, we're going to take the entire family of 6 to Disney World on that 10 grand. That's not going to work. If the care needed for that loved one is 24/7, the government has approved 2 caregivers. So theoretically, mom and dad can travel with the individual and have all 3 of those people's entire trip paid for out of either a special needs trust or an ABLE account and not violate the rules. If the trust or the ABLE account pays for the entire family, you have what's called a disqualifying distribution. That money becomes a taxable distribution, which we want to avoid. Okay? But other than that, the ability to pull the money out is free flow. In fact, in an ABLE account, we'll get into more details in just a second, there's an investment component where you can pick, similar to a 401k plan, one of 5 different investment options that vary in risk level, from most aggressive being mostly in stocks to the most conservative being in cash and bonds. And there's also a checking account component. So if you actually want to withdraw the money, it needs to be in cash. So you can go online. If it's all fully invested and you need a couple grand out for an expense, you go in there and sell a portion of the investment fund. It's then in cash. Then you can withdraw it. Most plans now have a debit card associated with it. For those of us over the age of 50, we still have the ability to write checks on the accounts. And in some states, you also have the ability to ask for a request. You contact the state and say, make a check payable to, and they'll send the check directly to whoever's being paid for services or goods. Those are your distribution methodologies to get the money out. But in comparing the plans, this is a simple page of the 10-page matrix we have. You can see that we're going to evaluate the cost structure, the limitations, whether there's a state tax deduction. So there's lots of different factors to consider as to which plan's best for you. The reality is they're all pretty close. You're going to have anywhere from 4 to 7 investment choices. They're all risk-based, meaning most aggressive down to most conservative being cash. And then you've got the ability and some for different kinds of distributions. Not all of them have debit cards, the majority do. And you can see there's pretty similar numbers across the board for that first page. But again, you're welcome to download that and look at that in more detail. Question in the back about able accounts.
Yeah, so I'm just trying to process some things that are coming up. Like, for instance, if you were purchasing like wheelchair van, but it's a family van that they're also riding in, like, would you hypothetically be able to buy the vehicle and the conversion out of an able account? Would you be able to modify things on your home, even as simple as building an overhang for where his shipments of like medical supplies are going to go rain-free? Like, I guess because all of these things benefit the family, but like we would be doing these types of things because of the situation.
Got it. One of my favorite questions, because I grew up as a CPA, so I love the tax-related type questions. Like, can I deduct that? How does that work? Can I pay for that? So the biggest question we get is often around the vans, the accessibility of a van. So a van that has specific wheelchair lifts and specific inside supports to keep your loved ones safe is absolutely an approved expense. And if you have a doctor write a simple note that says, a van of this sort will help keep so-and-so safe and secure, without it, their health is more at risk, all of a sudden, that van, that conversion of a van, that improvement to your house becomes a tax deduction. It's qualified under the medical deductions. So even though you're thinking, well, I put like a chairlift in my house, that wasn't directly medical. Correct, it's not. But if that makes it a safer way for your loved one to get around the house, if it's medically necessary for them to have that, and the doctor writes that letter to support it, you have a medical deduction. It also applies for education, which is bizarre, but you could actually have your loved one in a school that has specific medical supports, health supports for them to be safe and secure in a school environment. If you've got to pay out of pocket for that, have your doctor write a letter that says this is absolutely essential for their care. All of a sudden that gets added into the medical deduction because there's a 7.5% floor of your gross income, your adjusted gross income they look at. So if you make $100,000 a year, your medical deductions have to be more than $7,500 to be deductible. But if you can bunch up things like a home repair, an extra shelter, a conversion of a van, you're gonna be well over $7,500, in which case you'll get a deduction that year. So planning to put those things into a common tax year makes sense, and then you use it as a medical deduction. So one of the things that's unique about an ABLE account, the ABLE account distribution rules are broader than that of a special needs trust. An ABLE account can literally pay for anything for that loved one's personal benefit. And that's broadly defined. There's no regulation yet the government's written that specifies this counts and this does not count. So we as practitioners are advising our clients, look, if they're willing to broadly define it, we're going to broadly use it. That's what we do. So as long as it's for their primary benefit, and clearly other people ride in the family van, they're probably not going to be the one driving it. That's fine. But it's necessary for them to get safely from place to place. It qualifies. But for that challenge with the wheelchair, would you have otherwise done all those things to a vehicle? Probably not. So that's why it's going to qualify. Other details on ABLE accounts before we move on from that topic.
I have an online question.
An online question. Thank you, Rachel.
Got my mic? Yes. ABLE account versus working ABLE accounts, pros and cons? And then working ABLE account versus retirement account, pros and cons.
Okay, so I'm going to try to reclassify that question. So if you're employed and your employer has a 401k plan available, you can't use an ABLE account. Remember when I mentioned about the family that wanted these things created because their loved one didn't have access to that? Well, if our loved ones are working, they're supposed to use the available retirement accounts at work. There's not a choice. You can't add to an ABLE account once you're working. Someone else can contribute to it, but the person who's working cannot add to their ABLE account. An ABLE account can receive contributions from anybody. It's in the person's social security number so the government can track it, but it's a non-countable resource to the $2,000 limit. So you can have the ABLE account be $100,000, not be a problem. Anyone can contribute, but if you're working and have a 401k at work, you cannot add to it. You got to use your work's 401k plan until you lose that job. And if you don't have a 401k access, then you can add to the ABLE. The ABLE account is just as tax beneficial as a 401k. It's going to go tax-free. And if the money is going in pre-tax to a 401k, it'll go in after tax to an ABLE account. So the ABLE distribution will be tax-free. The 401k distribution will be taxable when it comes out. That's one of the differences there. What if you have a job and you're contributing and all of a sudden you lose a job? Well, you have to stop contributing while you're working. As soon as you lose the job, you can contribute again. Other people can continue contributing during the time you are working. You just can't make contributions of your own to the account while you're employed. Another question that came up prior to the conference is, what if you've got a college 529 savings plan for your loved one, and there's 50 grand in it, and for whatever reason, they're not going to go to any higher education after high school? We're sitting with a wonderful asset there. But if there's not another loved one that's going to go to college and use that money, what happens to it? Well, if you take it out, it's a taxable distribution on the growth above the amount contributed to the 529 college plan. But ABLE account. Ironically, the ABLE account's tax code number is 529A. It's in the same tax code section, like you really care, as college 529 savings plans. So what you can do is up to $16,000 a year, you can take the 529 college savings plan balance and put it in the ABLE account as a contribution. So you can roll it from one plan to the other tax-free, and then if the loved one eventually goes on to college or takes some additional classes later, you can use the ABLE account to pay for college and lots of other things, whereas the college 529 plan can only be used for higher education. Or under current law, if you want to use it for private school education, you can do that as well. But it's got to be used for education purposes only. So the ability to transfer it from a college 529 plan to an ABLE account gives you a lot more flexibility in distributions. So one of the challenges when you're receiving government services and benefits is that they want excruciating record keeping back from you, or they'll take it away. The good news about an ABLE account is at least in the first 5.5 years they've been available, the record keeping responsibility still exists for distributions. You need to keep track of where that money is spent and who benefited from that expense. But to my knowledge, none of our clients have ever actually been asked to produce those receipts. So it's not as if every time there's distribution, there's a filing, whereas it is for other government programs, which makes the ABLE account one of my favorite tools for planning because it's so flexible, it is tax advantaged, and you can use it for almost anything for their benefit. And the other thing I didn't mention, but think about how many times you've got a situation where at the end of the year or on a birthday, some generous relative drops $1,000 on your kid. Well, that's great. If they're receiving government benefits and you put that in their checking account and then they get their SSI payment, now they're over $2,000. If you don't clean that up by the end of the month and you're paying attention to it, they just lost benefits until you fix it. And you might not notice it for a couple months. So they just lost $2,000, $3,000, $4,000 unnecessarily. Take that $1,000 gift and throw it in the ABLE account. Okay? You can take it right back out when you need it, but it's a safe place to put those unexpected gifts from relatives. Back to that communication in the center of the matrix there, we want to communicate to our loved ones, hey, we have an ABLE account. We have a special needs trust. For this kind of a gift, we want it to go here. If it's something out of your estate when you pass away, it goes to the special needs trust. Because the cap, again, on an ABLE account is $16,000 of total contributions from everybody during the year. So if someone's going to leave a $100,000 gift at death, that's not going to work in an ABLE account. It's going to work in a special needs trust. So let's talk about those. So special needs trusts need to be drafted by attorneys. Okay? The reason for that is that it's a legal document, and the government's going to want to review that in determining whether or not assets in that trust count as a resource for your loved one or not. One of the challenges of special needs trusts is that with a special needs trust, the trustee has sole discretion on distributions. The ABLE account is owned by the individual. They decide what they want to spend it on. A special needs trust puts that power in the hands of the trustee, which is why the government does not count it as a resource for the individual, because the trustee can deny the access to the assets. Okay? So the special needs trust will not be a countable resource, can hold an infinite amount of money, so it's great for inheritances, such as retirement account distributions, life insurance, house passing to your loved one. The trust makes the most sense to be that beneficial owner. Now the question is, in a CMD community, do we need all those limitations? Well, we do if we're going to be receiving SSI and Medicaid, because it keeps the benefit value of those assets away from the person, keeps them eligible to receive those. If they're not receiving SSI and Medicaid, maybe just a regular trust would work just as well. Because a regular trust would have someone else potentially helping with the investment component, helping manage the assets and filing the tax returns. That's what a trustee is going to do. So that leaves the person to live their life and not worry about all the administrative hassles of having a lot of assets at some point in the future. But the important thing is there's no limit. So unlike the ABLE account, we can put more money into the special needs trust. But there's two different kinds. There's a third-party trust and that's a terrible slide. There's a third-party trust and a first-party trust. In fact, I'm going to go to the next one. This shows you the kinds of trusts we have. So a third-party trust, okay, is going to be the one we want to put all the assets we're giving to our loved one in. It's not their money, never was. If we put it in a third-party trust, when the distributions come out, it's for their benefit. There might be tax on the trust itself, but that can hold a lot of money from other people. No payback requirement to the government. Remember the ABLE account? If you've received Medicaid services and you die with a benefit balance in your ABLE account, the government gets first claim at that. Same thing for a first-party trust. If we've got a loved one, a relative, who drops $100,000 at death in our loved one's name, we're like, oh God, no, we're receiving public benefits. We can't have $100,000. Lovely gift, thank you so much, but now we got to put it in what's called a first-party trust, meaning it was the person's own money. The next day, they're eligible for benefits again. But similar to an ABLE account, that first-party trust funded with the person's own money is subject to payback to the government from Medicaid services. So whenever possible, we want money for our loved one's benefit to go to the third-party trust. And when you go to the attorney to have these drafted, we want to have them draft both and have them be standalone documents. What do I mean by that? Well, oftentimes they'll say, well, you don't have a very complex situation for your estate. Very few people have taxable estates right now because that would require you and your spouse to have $26,000 or more, $26 million or more. Hopefully you have 26,000, but 26 million is a tough number for most to get to. We aspire for that for our clients, but very few have reached that number. So that's where the estate becomes taxable. But the reality is, if we've got money that's being gifted, it's only a careless gift that gets into the first-party trust. Almost everyone will have a third-party trust, and it's a standalone document, meaning that we can walk into the Social Security office and just give them that. If your attorney's like, well, I can just do it all in your will and reference that when you die, a special needs trust is created for your loved one, and that seems like it's a cheaper way of doing it. The problem then is your will is going to have lots of other designations about people who will be involved in the care, the rest of your assets and where they're going to go, lots of other family information, and the government gets to read all of that if you're applying for benefits, because that's where the trust resides. It's in that will document. We want the special needs trust to be its own document. So when you apply for benefits, you say, yep, we have a special needs trust. It's currently not funded, but please read this and let us know if there's any problems having assets in this trust. And they'll read it for you and tell you thumbs up or thumbs down. You get the thumbs down, you went to the wrong attorney. Okay? Because the question you want to ask on the front end is, do you have clients who have used your documents and are receiving SSI and Medicaid? If the answer is yes, those documents are going to be fine. We want it to be a standalone document, 10, 20 pages, whatever that is, that you can then hand the government so they don't see the rest of your estate plan. Does that make sense? Simple request, the attorney can do it. It shouldn't cost any more to break it out. But have it there. That way, we've also had a situation where parents had the special needs trust created when they die. At our death, create this trust. What if the grandparent dies first? Aren't they supposed to? Of course they are. So if it doesn't come into existence until you pass away and grandma dies and wants to leave some money to your loved one, you have a problem. There's no trust yet. So if we have it available to be funded on a moment's notice, we're in a much better position. So think about that when you're talking with the attorney to have that drafted. And the thing you want to do is find an attorney in your state who's a specialist. But there's two different groups. You can go online and find an attorney in your state who specializes in special needs law. One is specialneedsanswers.com, pretty straightforward. Specialneedsanswers.com is the Academy of Special Needs Planners. It's mostly attorneys and a few financial advisors like me who specialize in this area. So you can find resources in your state through those groups. The other one is the Special Needs Alliance, specialneedsalliance.com. That's going to be another group similar. I don't know why we can't all be in one happy family, but it's another group of attorneys all around the country who do this kind of work. So you can find an attorney there if you don't have someone you know of that you want to work with. But use a specialist. It might cost a little more in the front end, but to avoid all the downstream problems, it's definitely worth a few extra $100 to use someone who's an expert in this type of law. The other types of accounts you might have, we talked about ABLE accounts. Helps us avoid going over means-tested limits every month by having a place to put that excess money. The other one you're going to have is if you're receiving SSI, there has to be an account that money goes to that's in that person's name. So there'll be an additional checking account typically. We want to spend that money down. If we can't spend that money down every month, we want to take the excess and put it in the ABLE account. Because if that accumulation of monthly monies from the government doesn't get spent, will be over $2,000. We're going to lose future monthly contributions from the government. We don't want that to happen. So those are typically the accounts you would consider for your loved one. Again, the question I think I have for this community is, do you necessarily have to have a special needs trust or just a basic trust? The difference between the two primarily is that for a special needs trust, it cannot be used for primary housing expenses, primary food expenses, groceries, and primary medical, things that would be covered by Medicaid. So you can't use the trust for that. If Medicaid denied a claim, or you want to use a specialist that Medicaid can't access, then you can use your money for that. So a trust has more limited distribution rules in order to be a non-countable resource. A traditional trust would not. So something for you to consider and talk to about with your attorney. If you're not going to be receiving SSI and Medicaid for your loved one, you might not need a special needs trust. You might need a trust, but not a special needs trust, because there's more limitations on that. If you have someone who's not an attorney drafted as part of a single document, are you covered? The answer is it depends. I don't know, I obviously haven't read the document, I'm not an attorney myself, but the risk would be that someone who's doing that kind of work is pulling documents off of a book on a shelf and doesn't practice special needs law. So it probably is going to have whatever the California code is to be a qualified special needs trust. But the challenge is going to be, what if grandpa dies first, right? And there might be money being left. That's a challenge. So Kevin Urbach, who's in the San Francisco area, is actually the president of the Academy of Special Needs Planners. I think one of the best attorneys in this area. So reach out to Kevin Urbach. He can review what you've got and tell you this will work, or you know what, you need to come see us or someone closer to wherever you live in California. But I do think that's a place where if you're going to save money in the planning process, don't skimp on the trust. If you need it, go to someone who's really expert at it, spend the money there, and don't hire me. Hire the attorney. Right, everybody always wants to save money on planning. The trust, if you need one, is not the place to skimp, in my opinion. So in a familial trust, where we have either a living revocable trust or some kind of a family trust, it says, okay, upon the parents' or grandparents' death, the loved one with a disability gets this share of the money, either outright or in a trust for themselves. If it's not in a special needs trust, then it's a countable resource to them, whether it's in a regular trust or whether it's in their own name. Now that counts towards their $2,000. Now, if you get to that situation and they don't change their documents, we're going to go here, first party trust. Because it went to them, now we need it in a special needs trust, we're going to put it there. So now the government's got the potential to get that money if they die with assets still in the trust. Avoidable, back to the whole communication issue. If you let the grandparents know, hey, beautiful estate planning, thank you so much for considering our daughter, but we now have a special needs trust. Can you redirect your living trust document to go to that special needs trust? Then you've got it locked down, it goes to the third-party trust, then it's not going to jeopardize benefits. So important to communicate with the elder generation about what you're doing for your loved one so that their best intentions, which are well thought out, don't jeopardize the other planning you're doing. Okay, thank you for that. All right, so let's keep moving here. All right, so beneficiaries. This is the place we see most people making mistakes when they come to visit us. And it can be really important to get this right, as we just talked about. How are those assets going to be transferred? So if you think about what the loved ones are going to get at the death of the parents and grandparents, the most typical assets are what? Life insurance, retirement plan assets. Well, my will covers all that, right? So if I die and my will says it all goes to the special needs trust, I'm set. I don't worry about that. Wrong. If your asset has a beneficiary designation, so life insurance, possibly even your credit card death benefit, if you've got one that has something like that, IRAs, retirement accounts, anything like that that has a beneficiary form associated with it, that asset goes where the beneficiary form says it goes. It trumps your will. So if you have a simple will that you think it takes care of it, it does not. You want to watch your beneficiaries. We've had clients swear to us, oh, no, we submitted that change to our company. It said the special needs trust. I said, that's great that you submitted it. Has anyone ever had somebody not do something administratively for them that they said they were going to do? So we ask, we verify, right? I think it was back in the Reagan administration, like trust but verify with Russia, I think at the time. Same thing here. We want to trust but verify. We love the fact that we sent the document in. We want to make sure that the person on the other end of that company institution did what we asked them to do. So what's on file? What's the current record? If I die tomorrow, who's getting my money? And by verifying that, then we know that it's going to go where it's supposed to go. And that's a really important factor because if you do all this other work and you end up with all of your wealth in a first-party payback special needs trust, what a shame. designate that third-party trust as a beneficiary for whatever assets you want to leave to your loved one. In addition, kind of a newer tax fact on this. If you've got a $200,000 house and a $200,000 IRA account, and you've got 2 kids, one who's got some challenges and one who does not, would you give each of them half of the house and half of the IRA account? Would you give one and one the other? Well, my recommendation would be that the loved one with the challenges gets the IRA account. The one who doesn't have the challenges gets the house. The house at death will have a step up in basis. They sell it the next day, there's no capital gain. So if the house is worth 200 grand, they get 200 grand. The IRA account, if it goes to the individual who does not have a disability, must be taken out over 10 years. If the individual without a disability is making $100,000 a year themselves, they're going to be in a relatively high tax bracket, and they have to take it out over 10 years. So it's going to be a big tax hit every distribution that comes out. Under current law, someone with a disability, if the special needs trust is named as a beneficiary, can take it out over their lifetime. We might be able to stretch that payment out 40, 50 years and have it go to a lower tax bracket. So if we're otherwise going to be leaving money 50-50, let's utilize the right account for the right beneficiary. And you can work with a financial planner wherever you are to get that figured out. But the benefit to stretching out an IRA account or a 401k account over a lifetime for someone with a disability is phenomenal. Anyone else, 10 years. A spouse has it over their lifetime, but anybody other than a spouse, it's a 10-year window. And it all has to come out and be taxed. Okay, so beneficiaries are an important thing to look at. One place that we haven't talked about, but it catches people on the $2,000 limit. Does anyone have a credit card they've decided to put their child on as a co-signer? Don't. If you haven't done it, don't do it. Give them a debit card tied to a checking account so you know how much is in there. The credit limit on your credit card counts towards their resources. That $2,000 limit, if your credit limit's $5 grand and they never spend more than $100 a month, the government doesn't care. You have a $5,000 limit. They have a $5,000 asset. They're not getting SSI. And if you walk into the government that day and you tell them, oh yeah, and they'll ask you the question, well, does he or she have access to any credit cards? You're like, yeah. Oh, really? Which one? Oh, it's at Chase. Really? Great. What's your credit limit? $6,000. Great. Denied. Have a nice day. Now you're in the appeals process. You're waiting 18 months with an attorney to get your benefits. So take that down as a note. If you're going to go apply for benefits, get the person off the credit card if they're on there. If they're not on there, tie a debit card to that savings account or checking account and keep the amount of balance in there under $2 grand. You won't have any problems. Okay? Let's go on to decision makers. Another really important topic and a new opportunity in terms of planning recently. So on the survey question we asked, who knows the difference between guardianship and powers of attorney? 80% said no. 100% walking out of here today are going to say yes. Guaranteed. I'll make this so crystal clear, you'll crush it. So guardianship, is that a benefit for someone or a loss? It's a loss. That's right. I only said that, but with all your mouths, I couldn't really hear it. So it's a loss. A guardianship is a transfer of rights from one person to another. It can be between 2 spouses. We see that oftentimes if someone's going through Alzheimer's or some kind of mental health crisis where they'll transfer their rights to someone else who can help them make their decisions. But oftentimes we see in the school systems that the schools, when your child's turning 18, recommend to the parents that they get guardianship for their son or daughter. I hate this. We speak in lots of public schools all around town. It drives me crazy that that's the standard answer to these families. Why? Well, it's so much easier for the school because now they can communicate with the parents, not the kid. Because when the kid's 18, they're an adult. They can choose not to go to class the next day, and there's nothing the state can do about it because they're an adult, they can make their own decisions. Under a guardianship, the guardian can demand they go to school until whatever their age of majority is for that school system. And while it makes it harder for the school, it also significantly compounds what you want for the rights for your loved one. Under a full guardianship, they can't vote, they can't drive, they can't marry, they can't sign a contract, they can't really do anything. It's a complete loss of rights. So everything in the Bill of Rights doesn't apply to them anymore. It's now given to someone else to do for them, which in some cases is appropriate. But for most cases, we want to start somewhere lower down this list. So an agent under a power of attorney. Oftentimes when you do your basic set of documents between a husband and wife, you'll sign a power of attorney that says, look, if I'm disabled, going to a hospital for life care decision making and I can't make my own decisions, my spouse can make that decision for me. Alternatively, on the financial side, we're closing on the sale of a house and my spouse has work commitments in another part of the country. Again, with technology now you can probably sign things remotely, but in the old days you couldn't. My spouse can now sign for me in the event I'm not available to sign. So powers of attorney give someone an equal right, but we're not replacing the rights. So if we think our loved one can make good judgmental decisions and not hurt themselves with bad decisions, a power of attorney allows you to see their medical records, help open accounts with them, talk to financial institutions on their behalf when there's a question. So it really allows you to do a lot of things with them, but not in place of them. Okay, so that's what a power of attorney is. The individual has to give you that right. So they have to sign the legal document saying, I want to give my mother or my father the right on my financial assets or my independent living issues. Typically it's healthcare decisions on the other part of that. So the new thing, though, that kind of is similar to a power of attorney is what's called supported decision making. I'm going to skip ahead a slide to show you the map of the country right now. This is a relatively new designation that does not require an attorney. The first two are going to require an attorney to draft a document for you. Powers of attorney are boilerplate. You simply check a box in a couple places and sign it. The trust is much more customized. But for supported decision making, find your state there and find your color. Illinois has it. Pretty much the entire Southeast is in process. And then there's kind of that plain states through the upper Midwest nobody actually lives in that's no. So the red states haven't started any legislation. The yellow states have legislation pending. The green states have it. So what is it? I think it's really cool. It's like a power of attorney on demand. You go to the state's website, you pull down their document. It simply says, for this type of transaction or this activity, you write in whatever you want. I want to name this person, whoever it is, to assist me. So it can be for a limited amount of time, or it can be until canceled. So let's say in my brother's situation, he wanted a car. We didn't feel comfortable going to a car dealership to negotiate that and then to sign all the financial papers. Well, having a brother who does this for a living, he might say, you know what? I don't want you to be my power of attorney for healthcare. I don't want you to see my medical stuff. But you know what? I'd love your help buying a car. He could download the document, sign it. We walk into the car dealership, and I've got just as many rights to talk to the sales agent as he does. As soon as we get the car bought, we tear that up. It's done. I'm out. So it gives you a lot of flexibility. Maybe there's different family members, different friends you want to have play a role. You can use supported decision-making in states that accept it to make that accessible. So it's a short period of time, very flexible, but it's not everywhere yet. We think that'll continue to expand throughout the country in the coming years. But that's an opportunity to think about going forward for your loved ones. You go back one. So that's supported decision-making. The trustee. We talked about special needs trust, traditional trust. One of the things that trips up our clients often is that they think the trustee is going to do everything when they're gone. Wrong. What is the trustee responsible for? Does anybody know? Very specific. The assets in the trust, period. That's their only responsibilities. Managing, maintaining, reporting on those assets, and making distributions of those assets for the beneficiary. That's their sole job. They're not making care decisions. They're not checking in every day to see if they're having a good day or not. They don't have any legal rights that a guardian would have, or someone with an agency under a power of attorney is going to have. So it's important to understand that. Sometimes people are going to say, well, I've got a trust, therefore understanding those rules and responsibilities, the different levels are important. Picking a trustee who's good administratively, who can handle financial matters, is really important. Then utilizing the other tools you have for decision making is really important. Hopefully your loved one can make their own decisions for their entire life. But if the time comes when they can't or they want some help, understanding the differences makes a lot of sense. And I would never start with the guardianship. If you need to go there, you can. The problem we've seen is that once you have a guardianship in place, the judge puts it in place. It's not something you sign. You have to go in front of a judge and they say, okay, I'm going to take away the rights from this person and give them to that person. If, let's say, 2 years later, the person says, you know what, I don't want them to have my rights anymore. I want my rights back. And the person agrees, yeah, I want to give your rights back too. You march back in front of the judge. You're now asking a judge to reverse him or herself. Judges sit above all else, right? They're high up. They tend to have egos. My father's a judge, I can speak to that. So you're now asking someone with an ego to reverse their decision 18 months, 2 years later. It may not happen. So it's not a guarantee you have the reversal of a guardianship once you put it in place. So don't take that one lightly. Move to that if you're afraid the person's being taken advantage of. If an agency under a power of attorney is not sufficient, then a guardianship may be appropriate. Vocational issues. One of my favorite topics. In this community, lots of people can work and do lots of wonderful things. That's fantastic. I want to remind everybody that the benefits of a job are not just the paycheck. It's the community. It's the camaraderie. It's the friendships that are built. It's the sense of self-worth. It's the ability to, have a career. Those are all wonderful things. And if our loved ones can do that in whatever capacity, even if it causes them to lose the benefits that they get from SSI because they're making more than $13.50 a month, I want you all to give that serious consideration. Because the anecdotal benefits are so significant and often overlooked. People just weigh the dollars. Well, yeah, if they get the job, then they're going to lose this. Well, yeah, they will. But if they can get close on the financial side, go for it. And we see that in a number of cases where my brother doesn't make a lot of money. He technically falls below the $13.50 every month. But he can't get SSI because the government looks at that and says, hey, he's working consistently for 20 years. What if he ramped up his hours? I'm like, did you see the 20 boxes of documents about his medical history? He can't do that many hours to make that much money. The government didn't care. My parents still decided they'd give up the money to give him a career. And every family's going to be different. But the ideal situation, if you can find it in your community, is what's called a benevolent employer. A benevolent employer is going to pay your kid $500, $600, $700 every month. Well below the amount they're going to start losing benefits. Gives them all the rest of those career benefits, those job perks that you get from being employed. And they can keep their SSI and Medicaid because they're not making too much money. Those are hard to find. Oftentimes we see families building a business around their loved one because they can't find the great opportunity in their community, which I find horrifying. We have to keep doing that over and over. There aren't better opportunities. But that's where we are right now. There's more employment coming for our loved ones in the future, but it's not what we need today. So think about that there's other benefits well beyond the paycheck, and then really look at what they want to do. The most recent example we have of this, we got a family who, wonderful child, really smart, has severe epilepsy, so needs 24/7 care. Went through the process of vocational work at school, through the transition program, and they said, okay, what do you want to do? Give me 10 ideas for what you want to do for your career. List them all out. Things like professional athlete, probably not going to happen. Movie star, unlikely. Musician, maybe. Astronomer, okay. Astronaut, challenged. So we went through all these things, but there were like 3 or 4 things related to space. And so what did the school come back with to the family? Want to guess? He can probably push shopping carts at the grocery store. What? That wasn't on the list. I can't tell you what I said when the family told me that because it's not appropriate in a recorded session, but it wasn't very kind. I was really, really mad at the school. Like, here's a kid who loves astronomy, loves the stars, wants to learn about the cosmos, and he's going to push shopping carts? And the dumbest part of the thing is he needs 24/7 oversight because of his epilepsy. If you're the caregiver, would you rather be outside in Chicago in the winter with him moving carts, or in an office looking at computer screens that deal with the cosmos? I know where I'd rather be supporting him, right? So we actually reached out through some friends and found him a great internship at Northwestern University working in their telescope lab because that's what he wants to do. And the stupid school's like, oh, we'll check the box that we got him a job because he's been pushing grocery carts. Wrong. Let's be advocates and say, no, this is what he wants to do. Let's reach out and find some connections we have and find those resources. So with vocation, it's always about what their strengths and interests are because they're going to make it work. If the kid wants to do it bad enough, they'll find a way to be successful. We just have to provide the opportunity for them. Housing. I mentioned my brother still lives at home. My parents are failures on this one topic out of 8. Great for them. They're in their mid-80s. They're happy to have him use his physical strength to help them. But at some point, they're going to pass away. And he's going to have to deal with the grief of that and a move all at once. That's not ideal for anybody. Now, for a lot of us, caring for our loved ones is easier at home. 80 to 85% of all of our loved ones live at home with parents. That's what the stats are. There's not enough housing. We talked about the benefits of doing ADA accessibility changes to a residence, tax deductible. Whether it's in your house or in a place they're going to live independently, great. There's also amazing technology now, where if our loved one's living independently in their own apartment, we can have cameras and like Alexa-type communication devices in all the rooms, so no matter what room they're in, we can see them and communicate with them, which is a wonderful way to create the safety and communication when they're living independently. And then whatever other supports they might need, whatever level of roommates they might want to have, there are better opportunities now than there were even a decade ago and certainly multiple decades ago. So I'd encourage everybody to figure out in your community, who's building the housing that works for your family? What kind of community situations are available? What's accessible to where they want to work? It's great if there's a great facility out here, but if their job's way over there and they can't get there on their own, that's not a great location. So have the communication within your community about what you want for your loved one, then go get it. It's really hard, but the more voices we have, the more opportunities will be coming. And then also think about the cost. If we own a house outright or in a special needs trust, not a countable resource. We got to know what the special needs trust can pay for. It can't pay for rent, and it can't pay for a mortgage. But it can own the house outright, no problem. So if we leave a house from a grandparent or one of you when you pass away, not a problem. Trust can have that, not going to jeopardize benefits. But understand how all that stuff plays together. Talk to your attorney about that when you're drafting documents about how you think the house might play into things. Care guide. This is often called a letter of intent with an attorney. It's basically capturing everything in a family's institutional knowledge about their loved one that's not going to be in a legal estate document. So what does that mean? Well, in my brother's case, he wants to turn off the light to his bedroom every night. If he doesn't, if someone turns it off for him, he's not going to have a restful night. Super helpful for a future caregiver to know that. Oh, I was just trying to be helpful. Yeah, you were, but you didn't know. Well, how would they know? We need a non-legal document that's going to capture that. So whatever those things are, have your loved one, if they're communicating well, they can draft their own. What do I want? What are my future goals and aspirations? Because if at some point they can't communicate as well, we want to have that there so that future caregivers can give them what they want to keep that life as full as it would have been otherwise if mom and dad were still involved. So that's the kind of stuff we want to put in there. We want to update it as transitions occur. Medicines, doctors, therapists we work with we like. Ones we tried and didn't like, just as important to document, because if someone else has to step in and you're not there to make those decisions, we don't want bad results. Even something as simple as Aunt Susie's a complete pain in the rear end, but she always wants to get in his face at holidays. Well, maybe we can have some events without Aunt Susie. That'd be great. So you guys know how to keep Aunt Susie away now, but when you're gone, Aunt Susie may invade more. We don't want Aunt Susie involved as much. So that future care provider would see that and go, oh, you know what, Aunt Susie, we're not available this weekend. Sorry. So those kinds of things get documented. Vest Life, we're not trying to promote any for-profit companies, but that's a wonderful website to look at as an example of what you can do. They charge about $40 a year, and it's compartmentalized. So you can say, for healthcare, for nutrition, for physical activity, for travel. These are all the things we like. Family traditions, holidays, things we want to continue to celebrate. And that way, if certain people play certain roles, you can give them access to those modules within the plan, update them, get their feedback. Other stuff that's more healthcare and private related just goes to the one person who's going to be dealing with healthcare decisions, possibly the power of attorney for healthcare. Okay? So think about how you want to lay that out, but think about what's most important that only you have in your head. That's what gets documented. Here's a list of things to kind of trigger your mind of what do we want to document. Again, the person, him or herself, should do most of the writing if they're able. Doing it electronically, we think makes the most sense, because if you have that, the likelihood of better outcomes is going to be greatly improved. Okay? Again, it's the most emotional document of everything we talked about. If my colleague Randy was here, she's a licensed clinical social worker, but she works at a financial services firm because this care stuff is really broad, and it's not just about numbers. She would tell you need 3 things for an excellent care guide. So write this down. Ready? You need, get your pens, wine, chocolate, and tissues. It's emotional. It's difficult. It's going to take time. It took her 2 years. Okay? It's not going to happen overnight. But do it in components. Get buy-in from people when you play in the roles. And back to communication again, the center of all of this. If you're going to name someone to play a role as a trustee, as a guardian, as a future caregiver for your loved one, tell them now. It drives us crazy that people put names in legal documents about future trustees, potential future caregivers, and never tell the people. Surprise. If they're going to say no, wouldn't you rather get the no today and change out those names when you can? When you're dead, it's really hard to change documents. We've had very few clients successful at doing that. So we want to get those people identified now, tell them what their role is, let them ask questions about what that involves, and then change them out if we need to. Okay, so communicate all this planning to people who play roles. Okay? And the vast majority of you do not have a care guide in place according to the poll, which is not uncommon because even my own family struggled with that for a really long time, despite having me tell them over and over to do it. So, things we don't want to see you guys ever make mistakes because you've attended this session. One, we're going to review those beneficiary designations and not trust someone else they did them. We want a special needs trust named as a beneficiary, not our loved one outright, if we have a special needs trust as part of the plan. Two, communicate, communicate, communicate. Everyone who's important to your family and your loved one's future care needs to be involved in the discussion. Thanksgiving is a great time to do it. If people are gathering together, it's informal. We even have little tip sheets about how to start those conversations to make them more comfortable. Then not utilizing all the planning tools. Those are 8 elements we talked about today. You've at least had a chance to think about them. You can go home and noodle over that more. You're welcome to reach out to me afterwards and say, hey, what about this? I heard about that, or I just want to draft this. Does this make sense? We're happy to answer those questions. But think about how all 8 of those things play into your family's future and figure out what's most important right now, prioritize that, and get those boxes checked. Okay? If you want another resource that's kind of fun, we created whiteboard videos like UPS used to have on their commercials for a number of years, where it's like a hand that starts sketching stuff and it kind of plays out. They're about 60 to 90 seconds long on a number of different topics, including some of those ones we talked about today. So if I was terrible and you're totally bored on your phone the whole time, totally cool, I get it. Go watch whiteboard videos, they're much more fun. It's not me, the one narrating them. And there's even one that I think is really great for our community, which is, what if we don't tell our first responders about our loved one in the house? What if they're on the second floor and need a chairlift to get down? And there's some kind of an issue where that's no longer functional because of some, whatever, electrical outage, problem with the house, etc. If they don't know about that, and they know the house, they might not know where to find your loved one. My own brother, right? He's autistic. He's got some other challenges too. He loves golf, like way too much loves golf. Well, on the weekends, you're not going to screw with his schedule. From like 8 a.m. to 3 p.m. or 5 p.m. on Sunday when the tournament ends, he's watching golf. Do not mess with that. He'll get his meals in, but do not mess with his golf. So sure enough, we had, in my parents' house, a smoke fire in the basement. House started filling with smoke. Alarms are going off. Piercingly loud. I don't know how anybody could survive that for more than a few minutes. So my mom and dad yell up to him, hey, Sean, you got to get out of the house. We've got a fire. Get out right now. Get out, get out, get out. My parents run out of the house. My brother really loves golf. The TV was still working just fine. So he's in his room watching golf. Piercingly loud noise going off. Smoke starting to build in the house, coming up to the second floor. He's still in there watching golf. Firefighters show up. They're like, is everyone out of the house? Is everyone safe? My parents are like, no. Where the heck is Sean? That might not be exactly what they said. But where's he? Probably up in his room watching golf. So they run up there and get him out. But if they know that there's a loved one who might react in an unusual way to a fire, to an emergency of some sort, knowing that in advance saves lives. We deal with a lot of families with mental health issues. Knowing that the person may not respond correctly when someone comes into their house is really good for them to know on the front side. It avoids really bad results that can be easily avoided. So I had that communication. There's a really cute video on that you can watch with your loved one and just explain to them why we're going to talk to the police department and fire department about our family. And then the last thing is, this says everything I said I may have just made up. You can't sue me for it. It's not personalized advice to you. Hopefully it's been helpful. And if you have more questions, you want to have more personal discussions, you're welcome to reach out to us, and you can reach us right there.